people then were bored of gold, and they said, well, when is the gold price going to move? And I said, well, I scratch my chin sagely, and I say, I think gold's going to move in 2000. In the year 2000, gold was at $253 an ounce, and now it's over 3,000. Gold has done almost 9% compounded for 25 years, and people had a strange sense that gold hadn't moved.
Yeah, yeah.
So I think what has happened is what had to happen. I remember in one of our earlier interviews talking about the difference between inevitable and imminent. The move had to happen, but it didn't have to happen in a time frame that was convenient to people. But now I think it's moving faster. And my own suspicion, Craig, is that maybe it's due for a rest, maybe it's not. Nobody knows in the near term. But I think the arithmetic around gold, and silver too, takes it not merely higher, but much higher. And if you'll humor me, I'd like to explain that in arithmetic terms.
Yeah, please.
In my experience, 50 years of watching these markets, speaking of time flies, the precious metals do very, very, very well when people are concerned about the maintenance of their purchasing power in fiat-denominated savings instruments. And I would suggest that the arithmetic around fiat-denominated savings instruments is very challenged, and people have reason to be concerned.
Yeah.
From here. First, let's look at the U.S. dollar. The U.S. dollar is constrained, I would suggest, because the U.S. government's on-balance sheet liabilities exceed $36 trillion. We've talked about that before. The much scarier number is the off-balance sheet liabilities. The net present value of Social Security, Medicare, Medicaid, federal pensions, military pensions. That number, according to the Congressional Budget Office, exceeds $100 trillion. So the net obligations of the guarantor of the U.S. dollar are over $130 trillion.
Yeah.
Craig, to put that in perspective, the Internal Revenue Service estimate of the private net worth of Americans is $141 trillion. So there's $11 trillion left over. But it gets worse.
But wait, there's more.
Every year, the on-balance sheet liabilities of the U.S. government increase by $2 trillion a year. And every year, the net present value of the off-balance sheet liabilities of the U.S. government increase by $2 trillion a year. People say, oh, well, hope is in sight. We have Elon, the Department of Government Efficiency. I would urge people to read a book called The Triumph of Politics by David Stockman. David Stockman was the director of the Office of Management and Budget in the first Reagan era, and he talks about the derailment of the original Department of Government Efficiency by political forces in 6 months. I don't think it's going to work.
Yeah.
What I think is going to happen is what happened in the decade of the 1970s. In the 1970s, your older viewers will remember that we fought the war on poverty in the 1960s, which we lost. And we fought the war in Vietnam, which we lost. And it was politically unpalatable to cut any programs. Even the conservatives wanted their Social Security, after all, and industrial subsidies and stuff like that. And so what we did is, rather than change the nominal value of our obligations, old codgers like me who were promised X in Social Security still got the X. But what happened is that they depreciated away the dollar. They reduced the net present value of the obligation by depreciating away the purchasing power. In the decade of the 1970s, according to the Office of Management and Budget, the purchasing power of the U.S. dollar declined by 75% in 10 years. This is not an alarmist Rick Rule number. This is the Congressional Budget Office. The Office of Management and Budget. Not coincidentally, the gold price increased 30-fold. Now, I would suggest to you that the move from $35 to $100 had to do with taking away price controls on gold, deregulating the price of gold. But the move from $100 to $850 was all about the deterioration of the purchasing power of the U.S. dollar, and then later on piling on to momentum. I believe that over the next 10 years, the purchasing power of the US dollar declines by 75% again. I believe that an old codger like Rick Rule, who's getting paid whatever he's getting paid, $4,000 a month in Social Security, whatever it is, continues to get that. But that by the end of 10 years from now, it buys 25% of what it buys today. And I believe that the consequence of that is that the gold price trades not merely higher, but much higher. And I want to give you two more pieces of arithmetic. Another reason to be concerned about the deterioration of the maintenance of purchasing power in your savings is the fact that I would suggest that today the real interest rate that you receive on your savings is negative. The government would have you believe that the CPI stated rate of inflation at 2.6% is the real measure of the deterioration of your fiscal living standards. But it's not. The CPI, when it's inconvenient, doesn't include food or fuel. Any index that doesn't include lunch is of no interest to me at all. But probably more importantly, it doesn't include tax. The most important living expense of most households in the United States is tax. 36% of GDP. It isn't measured in CPI. I would suggest, as a thought experiment, that your listeners look back at the price levels of the goods and services that they bought in 2020. Gasoline, mortgage interest, health insurance, health care, food. What you'll find is that for the basket of goods and services consumed by most Americans, that the deterioration of purchasing power of their currency is more like 7.5% than 2.5%. So if you do a bit more math, if you buy the U.S. 10-year Treasury and you get paid 4.5%, in a currency where the depreciation of the purchasing power is 7.5%, you're not making 4.6, you're losing 3. And if you do that for 10 years, if you lose 3% compounded over 10 years, the U.S. government solemnly swears that if you give them the money for 10 years, they'll give you back 40% less. A promise that they think they'll keep, that I think they'll keep.
Yeah.
One more piece of math around gold. According to J.P. Morgan Chase, the market share of precious metals and precious metals related investments in the United States relative to all of the other asset classes that Americans own is only 0.5%. That is to say, 0.5% of total savings investment assets in the United States is demarcated in precious metals or precious metal securities. The 4-decade mean market share is 2%. So if gold doesn't demolish NVIDIA or outperform the S&P 500, if the treasury market doesn't crash, if all those sort of weird gold bug things don't happen, if sentiment merely returns to 4-decade mean, demand for the stuff goes up fourfold. I have no idea what a fourfold increase in demand does to the price. But remember that prices are set on margin.
Yeah.
I believe that the likely consequence of a 75% deterioration in the purchasing power of the US dollar and the consequent increase in interest and hence market share for precious metals takes precious metals over 10 years, maybe not over 10 months, but over 10 years, not merely higher, but much higher. And if I'm wrong, I don't think you lose much. A little bit of gold ownership goes a very long way in terms of hedging the rest of your portfolio. Let's say that the average American goes from 0.5% to 2%, or for most Americans, from nothing to 2%. If the gold price escalates threefold or fourfold, that 2% investment saves 10% of your portfolio. If by contrast you go to 10%, that shields 40% of your portfolio. For those people who remember the decade of the 70s, a portfolio comprised of long bonds, which saw the 10-year interest rate go from 4.5 to 18, saw long bond portfolios decline by 75%. You have what you believe is a riskless asset. You enter the decade with $100,000 in savings, and you exit the exit with $30,000 in savings. If you had sheltered 40% of that loss with gold, you still wouldn't feel great, but you'd feel a hell of a lot better. In equities, We had, people forget this, we had what was in effect a 12-year bear market in equities, 14 years, 1968 to 1982. The equities didn't go down, but they sure didn't go up. And if they didn't go up and the purchasing power of the dollar declined by 75%, guess what happened to your real wealth in an equities portfolio? I'm not suggesting that people sell their equities, that they sell their house, that they sell their bonds and buy gold. I'm suggesting that they take their market allocation to gold, unless they believe that the Department of Government Efficiency is going to wipe out $130 trillion worth of debt.
Yeah.
And they add some gold. That's all I'm suggesting. I think there's three things that explain the disparity in performance between gold and the gold shares. The first is that the gold price has moved up because of foreign central bank buying. And foreign central banks don't buy gold shares. So if an asset class moves because of the existence of an investor base that doesn't exist in the other asset class, of course, the shares wouldn't go up.
Yeah.
You don't see the Chinese central bank buying Newmont. Investors, including gold investors, remember the dismal corporate performance of the gold sector in the period 2000 to 2010. Well, the expectations from the gold shares for the last 15 years haven't been low. They've been sub-zero. The challenge has been to get under the bar. But the performance in the gold shares, at least the better gold shares in the last year, has been, a bad pun, sterling. If you look at the stocks that you and I talked about 18 months ago, we talked about the fact that the beta in the gold market was going to be more achievable than alpha, which is to say the amount by which the gold shares outperformed the broad market suggested that investors overshadow high-quality companies for low-quality companies. That's worked. Franco-Nevada, admittedly having sold off as a consequence of Cobra at Panama, comes back 40%. Wheaton Precious, 50%. Agnico Eagle, 60%. The companies that have delivered good corporate performance have been really, really, really rewarded in the market. And the anatomy of the three prior gold bull markets that I've lived through have all been the same. Gold leads, then the highest quality gold stocks move.